Hi everyone. In this video, I am just going to introduce you to the overall concept of intangible assets, as well as introduce you to some of the most common types of intangibles that you might see on companies' balance sheets. So, intangible assets. What actually defines an intangible asset? Well, it's an asset without physical substance. That is the key differentiator between that and, say, a physical asset like PP&E, fixed assets. There's no physical substance to intangibles. Instead, what they are is legal rights, privileges, or other competitive advantages that companies have. So some of the common ones you see listed here: patents and copyrights, franchises and licenses, trademarks, trade names, and goodwill, all of which I'll talk about in more detail shortly. One thing I do want to note, and I want you to keep in mind as I talk about those common types, is that sometimes you will hear about companies spending money for research and development. Research and development can lead to the creation of an intangible asset. However, research and development itself is not an intangible. That is just a cost incurred that may ultimately give rise to an intangible. But research and development itself is an expense. All right, let's talk through some of the common types. First up, patents and copyrights. So patents. Patents are basically legal protections over inventions. And so over here you see I have an example. This was taken from Apple's filing of its patent for the original AirPods. So you kind of see the flip case design, you see the AirPods inside, and you see all of these little notations, and then Apple kind of explains what all those various parts and whatnot are. So this is its filing with the US Patent Office to make sure that its design over the AirPods was protected from people copying it. This gives them an exclusive right to manufacture, sell, or otherwise control that designed invention for 20 years. Now, the capitalized costs that you are allowed to put into a patent are basically the expenditures to either acquire it if you bought it from someone else, or to legally defend it if you end up having to go to court over it. All of the research and development that went into, say, creating the AirPods, that is an expense. That's not part of the capitalized cost of the AirPods. It's simply, in the case of Apple, they didn't buy the patent on the AirPods, they developed it itself, but to the extent that they need to legally defend it, they will be able to capitalize those legal defense fees. Copyrights are very similar. It's another legal protection. However, instead of over an invention, it's a legal protection over published works. And here I say for the life of the creator plus 70 years. Now, that's when an individual creates a copyrighted work. For companies, those metrics are a little bit different. And also, this has not stayed stagnant over time. The lifespan of copyrights has changed, and chances are it may change again in the future. So this video might become outdated. So don't hinge on these numbers right here. Just know that copyrights are legal protections over written works, and that includes both writings and drawings, so artistic works count in there as well. What do you get to capitalize to a copyright? If you buy the copyright, the acquisition cost. If you have to defend it in court, the legal defense fees, okay? Similar to a patent. All right, let's move on to franchises and license. So franchises are contractual arrangements between a franchisor and a franchisee to operate a business. So many fast food places do this, Subway being one of the most notable ones, where when you walk into a Subway, you aren't necessarily walking into a corporate controlled branch of that business. You're actually probably walking into a franchisee's location, whereas the company Subway is the franchisor that is giving them permission to essentially run that branch. Others do this too: McDonald's, Chick-fil-A, bunch of fast food places. What do you get to capitalize if you have a franchise? Well, any initial expenditures to obtain that franchise. Sometimes the business gives you some of the items you need. Sometimes you have to invest your own money to get items that you need. To the extent that any of those expenditures are your own and they are required to get the franchise up and running, essentially, you can capitalize that. Licenses are very similar, except instead of it being an arrangement between franchisor and franchisee, these are contractual arrangements with the government that allows the business to use a public property of some sort. So think of a license to use a sewer system, a license to use a particular stretch of road or land, a license to use electricity or cable lines or whatever the case may be. The capitalized costs include the initial expenditures to obtain the license. So any money you have to essentially give the government to get this permission right up front, that's what you get to capitalize. All right, last up, trademarks, trade names, and goodwill. So trademarks and trade names we simply lump together. Trademarks are essentially your various symbols. Trade names are the words that go with them. And it doesn't have to be visual. It can be your musical jingles that are associated with your brand, in addition to, say, symbols that go with your brand, or the words that go with your brand, okay? Trademarks and trade names are protections to give you exclusive right to these symbols, jingles, words. And they have a 20-year lifespan, but they are renewable every 20 years. So you can continue to renew that trademark and to have that protection indefinitely as long as you remember to file your paperwork every 20 years. Your capitalized costs include all expenditures to, if you bought it, acquire the trademark or the trade name. Okay, that brings us to goodwill. Goodwill is a tricky one. And the best way to say it is goodwill is essentially the value that gets created when you combine two separate companies. So let me use McDonald's for an example here. McDonald's as a company makes a lot of hamburgers, and making those hamburgers requires a lot of beef. If McDonald's decides to, say, acquire a cattle farm, it might actually create value that did not exist when the cattle farm was its own business and the McDonald's was its own business. In other words, by McDonald's streamlining things and bringing the cattle farm under its own umbrella of operations, there might actually be an enhancement in value generation. That is what is known as goodwill. And so you see some examples I have here: operating synergies, desirable locations, skilled employees, positive public perception. Whatever form that value creation takes, that's goodwill. Now, how do you put a price on that? That would be really hard, right? Except the way we do it is actually quite simple. When a company gets bought, it's got some sort of fair market value that is assessed on it, usually by a professional appraiser of some sort. To the extent that, say, McDonald's would view the cattle farm as generating value, it would be, in a competitive market, willing to overpay from the fair market value of the cattle farm. So the cattle farm's worth a certain amount. McDonald's is willing to pay not only that amount, but for the additional value creation. And so to the extent that McDonald's overpays, that overpayment, that excess money spent to acquire the business, that is what you put in your books capitalized as goodwill. So that's it for intangibles. One last point that I just want to make before wrapping this up is in many companies' cases, if you have generated your own intangible asset, you generally won't see a lot of money on the balance sheet for it. Think about those patents and copyrights and even the trademarks. If you develop it yourself, all the R&D, the research and development, that gets expensed. The only time you really get to put any money on the books is if you have to like legally defend it or file paperwork for it or something of that nature. And so, you know, McDonald's Golden Arches, they're worth a fortune. But if you look at McDonald's balance sheet, you don't see an intangible asset called Golden Arches with billions of dollars in value next to it, even though that is probably what it's worth. And that's simply because McDonald's didn't go out and buy it. It didn't establish a market price for it. It's probably worth a ton. But you don't know that until you sell it on the open market. And so when you see companies that have large values in their intangibles, it's usually because there's been a market transaction. Notice all those examples we went through. When you acquire, when you buy a copyright, buy a patent, pay goodwill to acquire a business, that's when you get to record that. And so it's usually when you've bought something in an open market that it drives up the value of intangibles on the books. Otherwise, they tend to remain relatively low, representing only essentially what you pay to file the paperwork, and then of course like legal defenses and things of that nature. So that's it for your intangible mini lesson. I hope you found this helpful, and I hope you join me for another video.